Hi, everyone. Welcome back to the InvestPal podcast. My name is Cam. I'm pleased to welcome Dave Thornton on today. Dave is the CEO and co-founder of Vested, a platform for startup employees to exercise their options. Dave, thanks for coming on today.
Happy to be here.
So, as an individual who spends a lot of time in the startup world, I'm curious, maybe just a quick overview on Vested and what you guys are all about and how you're helping provide some liquidity to startup employees.
Yeah, happy to describe it. Vested's liquidity solutions are a bit of an accident. Uh, Originally, Vested was a company whose primary job was to help startup employees understand their equity at all. Just what is this? What's the difference between stock and stock options? What's the difference between incentive stock options and non-qualified stock options? Is your option grant fair? So Vested was originally kind of a knowledge provider, but in our first year and a half of existence, some of our user base that initially came to us looking for education around what was typically stock option grants, but their equity writ large, started to come to us looking for money. And when we investigated what the use case for the money or the potential use cases, plural, it was almost entirely an employee who had recently departed their startup for whatever reason, finding out, typically for the first time, that they now have 90 days within which they have to exercise their vested stock options or else they lose them entirely. And that was kind of the beginning of our journey into providing, I guess liquidity is the right word. We don't think of it as liquidity because liquidity has a cash in pocket connotation, but funding for stock option exercise so that the employee who doesn't have the $70,000 that they all of a sudden need to find within 90 days can attain it and use it to exercise their stock options and pay taxes.
So does that mean that you would be there essentially providing them a loan to buy those options in which they own now the equity piece behind it, or you are purchasing the equity from them?
Yeah, very good question. So we could have gone either way. And there are providers out there in the market that do loan-like products. We chose, for the purposes of mitigating regulatory risk, to do a straight purchase where we're buying only the minimum number of shares necessary for the employee to get all the money they need to do both their exercise and pay the related taxes. The goal is for them to own as much as possible and for them not to have any loan-like scariness hanging over their head.
Okay, interesting. So with the private markets in general, especially in like the startup world, this isn't priced daily or intraday like a typical stock would be. So is Vested helping provide a fair market value, or is that more on the company to say, hey, our last round or our current valuation is 10 million? You will be receiving the options with an equity value, fair value of that 10 million, or do you guys do some updated pricing as a result of that?
Yeah, that's a very good question. And actually, in order to answer that question holistically, I think I need to describe a little bit more about the part of the employee market that Vested serves.
Yep.
So when the interest first came inbound from our own user base for capital around this particular use case, we thought it was very cool, but we were also like, this is not a new problem. There has to be an existing market for this. And when we looked at the existing market, what we saw was, although there are providers of funding for stock option exercise, they are primarily focused on senior people that were leaving late stage private companies. Think of Stripe and SpaceX as name brand examples.
Mm-hmm.
And the folks that were represented in our user base that were coming to us were what we would call the other 99% of startup employees, that primarily rank and file startup employees that need 30 grand, 120 grand, 80 grand, some number that is big for an individual, but below the who cares threshold for your typical investment firm that's trying to put millions of dollars to work. And so conceptualizing of ourselves as the stock option funding provider for the other 99% of startup employees comes with a handful of operational issues. So if we're helping, they're by our count, there are roughly 30,000 US headquartered venture-backed companies. We're potentially helping people from all of them. It is nearly impossible to price 30,000 venture-backed companies as an outsider. And so what we did to start was we relied on the pricing that currently existed. And for every company that has common stock, there's a regulatorily mandated 409A valuation that must be done, which is produced by an independent valuation provider every year, and it subsequently goes up to the company's board, and it is approved as the current fair market value of that company's common stock. So just kind of to make our lives easy / possible in the beginning, what we would do is we would tend to buy at the price that already existed, which is the board approved company fair market value.
Interesting. Okay. So that 409A happens, let's say January 1st. If they're coming to you September 30th or after that, you're still reflecting it back to that previous 409A valuation?
Yeah, which is typically okay in a normal world where markets have not gone down recently or gone up recently. That'll be fine. And venture-backed companies tend to raise rounds every 2 years on average, so it's actually perfect timing and very timely and up to date to use 409As, which are done, or current FMVs, which are refreshed a minimum of once a year. It's only in markets where things have moved fast recently that may not be appropriate.
Okay, gotcha. So with that said, are you able to pinpoint, like I see there's private market data providers out there who look to provide some insights around what's going on in the startup world. A lot have seen a reduction in deal volume and valuation compression and all of that. Are you seeing the same thing when it comes to Vested and, access to those, let's call it pool of 30 VC-backed startups out there?
Well, I guess there are two parts of your question. One's the data thing, and then the other is the supply access. On the supply access side, no, in fact, the opposite. So call it somewhere between a year and a half and 2 years ago when the private market started to crash. One of the things that you saw a ton of was companies, whether or not they needed to survive, doing belt tightening layoffs.
Yeah.
And layoffs are one of the many reasons that people leave startups, and layoffs produce deal flow for us. So we actually saw an uptick during that period of time.
Right.
And the uptick has kind of maintained, not all the way through now, but it wasn't like a 3-month uptick. It was like a year and a half uptick.
Okay. So with that said, though, around the actual, what the data is painting a picture around, are we seeing valuations rebound and volumes? Maybe it's sort of not volumes, but on the actual deal and company valuation side, that come back to life?
So the best visibility we have in that, I mean, there are many lenses through which you could potentially answer that question. The one that most people mean when they ask a version of that question is our primary deals, like our fresh capital into companies going in at new arm's length prices. That we don't have. We have plenty of visibility because we have lots of data sources, but the best visibility that we have is actually when employees come in and they share the information that's necessary to share with us to understand what their exercise and their tax obligations are for their stock option exercise. And one of the things that we've seen very clearly, employees have to understand what the current FMV is because it produces the tax consequences of their exercise, which can sometimes be bigger than the actual strike price that they need to pay. And we've seen FMVs get written down pretty dramatically in the last year and a half. It's hard to paint with too broad a brush, but because the later stage companies got hit a lot harder than the earlier stage companies from what we can tell. But I would say that the overall, if I'm just being perfectly average, FMVs are probably down like 50%.
Oh, wow. Okay. Yeah, you hear a lot of companies doing down rounds, but I thought we had the bottom established about a year ago. So you're saying it's still quite depressed and it hasn't really seen like a bump off of that reversion lower?
The bottom's been, in my view, I think the bottom's been established. However, there's not been an FMV recovery yet.
Right.
So we're still down there where we might have gotten to, in the last year or 6 months.
So is Vested primarily focused on later stage companies? Like, are you seeing any dynamic within the actual, I'll call it like the company life cycle where like a, do you ever deal with like a seed stage or like a series A type of company and helping facilitate
Yeah,
liquidity there?
we can help companies of almost all stages. We're artificially at the moment restricted at Series A, so we've got a couple Series C deals that are in our prior portfolios, but for the most part, it's A and above, which is still quite early in terms of private company maturity. We can handle any stage, and we tend to see rank and file employees, so that includes people that are leaving the Stripes and the SpaceXs of the world. But because the market that pre-existed us had coalesced around the late stage companies, we see more early and mid stage stuff.
Okay, gotcha. So we're talking a lot on the company side. Do you ever deal on the opposite end with the funders, with the funds looking for access to startup capital as well? And if there's like a lot of dry powder sitting on the sidelines to end up reinvesting back into I'll call it a more reasonably priced private market?
No, but for a very practical reason, not because that's not a good idea. I think we should work more with VC funds, and I think VC funds should work more with us. But when we started, we initially did our deals with the employees directly
Hmm.
on a forward basis, meaning we would purchase the subset of shares necessary to get them all their money for their exercise and taxes. Uh, but we would give them the money today, and they wouldn't actually deliver the shares until transfer restrictions had left. And initially, we made that choice because our goal was to help somebody with 8 days left on their clock actually get their exercise done before their expiration. And if you have 8 days left on your clock, you can't possibly bring in a company to do a right of first refusal process followed by a retitling of shares and all that stuff. Um, but in our initial fund, after we got the deal done with the employee and after the employee took our money and did their exercise and the clock was off, we would go back to the companies and find anybody that we could and say, hey, we just helped out Cam for $34,000. Would you mind retitling just the shares that we bought? And the companies gave us really clear feedback that for our particular counterparty and use case, they would prefer not to be involved in the transaction, which is unusual. Like most of the time, you'd expect a company to care quite a bit about when their shares are being transacted, but the characteristics of our deals and our counterparties that made the companies not want to be involved were number one, they don't want us on the cap table for they don't want anybody on the cap table for $34,000, even if we're the most value additive $34,000 of all time.
Yeah.
Number two, if we transacted anywhere other than the current FMV, and we tried to stick with the FMV for a lot of reasons, but it's discretionary, and so we could conceivably bring them a deal that was not done at FMV. And then we told them about that deal, they might feel obligated to redo their 409A valuation, which is just a pain in the butt for no reason. And then, kind of on the flip side of those frictions, we were helping out 1 or 2 or 3x employees for small total dollars. And like, there's no disincentivization precedent if somebody that doesn't even work at your company anymore sells a small set of their shares to own the remainder. So there's kind of like nothing for the company to get in front of from a precedent perspective. And
Right.
so for all those reasons, the companies were like, for this thing that you guys are doing, the way that you guys are doing it, you should keep working directly with the employees. And that actually is the answer to the VC question, because VCs tend to have direct relationships with management teams. And they don't want to be the optics of doing a deal outside of the purview of the management team is just sufficiently bad that they're probably not going to do it unless I don't know. I don't know unless what, but I've become aware that they would prefer not to do those types of deals without putting them on the management team's radar, which is kind of antithetical to what the management team itself wants. So for that kind of dumb reason, we don't work with VC funds.
But would that be like the primary VC fund though? Like I remember listening to like the All In podcast and like Jason Calacanis was saying he's trying to take like a 2% position in Andril, and I imagine he's doing so by buying secondary through departing employees. So like do you have like maybe not their primary fund owner, but these other sort of like notable people who weren't privy to the primary round trying to
Yeah,
get exposure
for,
now?
for folks that don't have that management company relationship to worry about, then yeah, we can totally help them out. And as long as we stay in our lane prescribed by the company, which is we're helping a small number of ex-employees for small size, then yeah, we can work with any partners, any capital partners.
Do you see it being a benefit? Like, there's a lot of companies that have, like Stripe, have not gone the public road and have stayed private for a very long time. And there's a growing trend. I forget, I'm going to throw a random number out. Like, the average time to IPO is like a decade or something now. I don't know. You probably know better than I do.
Yeah, it's
So
like
in fact,
it's 10 to 12 years at this point, which is a long time.
yeah, very. So you'd think that like an employee might want to liquidate their holding then. Do you see that as being a barrier for startup employees now, on that lack of liquidity in the market? And there,
Most
there's the lure of joining a startup, it goes public, everyone gets rich, and now it's this long waiting game.
Yeah, it is definitely a problem for, I mean, employees stay at a startup on average 3 years.
Yeah.
So you can do the math. If it takes 10 to 12 to get to a public exit, and even if it takes 6 to get to an acquisition or something like that, a version of an exit that's still a good exit, which would produce liquidity for you, the employees are typically not there. And so it would be nice to have a fully functioning secondary market where all the names traded at reasonable prices so that employees could not only find the capital to exercise their stock options, but occasionally sell some of their stock when they need to put a down payment on a home or something like that. But it just is not the way that the world works today. I mean, hopefully some of the work that we're doing in helping the long tail of rank and file employees for lots and lots of companies rather than a small handful does something to move the world in the right direction, but it's a big problem. And I kind of think that there are benefits to everybody to those secondary markets developing. So I think that the founders that really make an effort to try to build the secondary markets with capital providers on behalf of their employees, they'll see recruiting and retention benefits, because
Absolutely.
everything else equal, you'd much rather work at a company where the stock is not a lot like a paper lottery ticket, but can be turned into cash from time to time. And once the first recruiting and retention winners actually get the better people and keep the better people, I think then it'll log roll to the rest of the companies.
I wonder though, like, I have seen, I don't know how many ATSs out there, those alternative exchanges, none of which seem to have the promised liquidity that they're aiming to.
It's because there's no buy side. You have to have data on the companies for the buy side to show up. So there are plenty of, all the employees will potentially be sellers at various points, and early investors are always going to want looks to unload before, year 10 or year 12. But if you've never heard of this company, even if they're doing great and they just took an up round and you can't see financials and you have no other real way to vet it, like, there's just no demand for that name. And that's my view of the reason that there's only ever been a few hundred names that trade on the secondary markets, despite the fact that there are 30,000 and change venture-backed companies.
What do you think that big inhibitor is? Is it just like the regulatory burden it brings onto a management team to go public?
Do you mean the inhibitor for a company going public?
Yeah, like the reason that they're like, staying private for longer, is it just like they don't want to be priced? They don't want to like provide a pathway to liquidity?
Yeah, just my 2 cents as a founder is that sounds like a pain. Not the pathway to liquidity thing on behalf of employees, which I'd be more motivated by, but doing, my old company was acquired by a company that subsequently went public, and I got a little bit of visibility into what it was like to prepare for quarterly earnings, and it's terrible.
Yeah.
I don't know why I would sign that up for myself if I didn't need to.
And you always see that curve, like after like the company's life cycle, and once it IPOs, it typically IPOs after all of the growth for the most part is done. So it seems like, we're laser focused on growing the company, and maybe it's a correlation, not a causation, but once they go public, the growth stalls, and either the management team is perfectly predicting that, or all of that extra reporting ends up slowing down the innovation behind the scenes and prevents them from growing as quickly.
I feel like it's more likely the first, that all the growth is happening while the company's private, mostly because it's possible to stay private these days for longer and longer periods.
So what are you seeing in terms of, like we have a lot of, besides retail investors who listen to this, a lot of investment advisors who tune in as well. And there's a growing theme around alternative investments, especially in the VC space. do you have any thoughts to them on how they can get exposure to private equity into venture capital?
Yeah, plenty. I mean, this has been the mirror side of the employee needing cash to fund their expiring stock option exercise journey has been us understanding who the investors are that care about nominally being on the other side of that employee. So one thing I should mention is that the capital that we provide to employees, it tends to come from a dedicated, committed pool that we've already raised from investors. And what we do is we help employee by employee, small ticket by small ticket, leaving many companies of all stages and all sectors. And the product, the investment product that we've created to date is almost like a proto VC index fund.
Okay.
And in thinking about that construct, we've started to understand at least parts of the investor market that have never had access to VC, or if they could have access, they don't have the access that they like. And what we've seen is a couple things. One is you need to be able to write a pretty big check in order to get into what you'd call the brand name VC firms. And there are plenty of people that can write, again, for a regular person, big checks that are not the 10 million that you need to get into, I don't know, Andreessen. And they've been pretty locked out from an access perspective because they can't write a check that's big enough. There's another set of investors that maybe they could write a check if they wanted, but they're also a little bit nervous about single manager, single vintage type risks, because despite the fact that if you do well in VC in your prior fund, you are as likely as in any other asset class or more likely to do well in your next fund. The proportion of people that were top quartile fund managers last vintage and are also top quartile fund managers in their subsequent vintage is like 49. So that's the biggest number that you see. Like, I think private equity is in the 30s, and hedge fund it's like way lower. But that's not better than a coin flip.
Yeah.
And so you can imagine saying like, oh my gosh, am I about to invest in somebody who did well last fund who's about to revert to the mean? So that's a nervousness that people have too, aside from just being able to get access in the first place. And so I think that for the folks that have been locked out of VC for those two reasons, an index fund construct makes a ton of sense. You can write one ticket and get access to very broad coverage within the asset class, inclusive of the companies that are backed by Sequoia and Andreessen and all the big names. Also, because you're effectively getting manager diversification, the single vintage, single fund manager type risk is as mitigated as it's going to be. So right. I really do like the index fund construct for all the high net worths that have wanted to be in VC, but either not had a chance or not been comfortable.
What does the redemption look like for those people participating? Since it is more of an index fund, does that mean there is more liquidity on the investor side as well, or they could end up redeeming intra-year?
It kind of depends. So fund structure has a lot to do with ability to redeem. But liquidity, like what the investor wants is the ability to get some money out of the fund periodically, and that can come in a number of different forms. Redemption is just one of them, which is you selling all of your interest in the fund. The index construct definitely does a good job for producing liquidity, even if it's done in a private fund with a 10-year lockup, in the sense that if you put 1,000 companies into a fund, like I promise 50 to 100 will be liquid at some point next year, even though I may not be able to tell you which 50 to 100 that will be, standing where we are now. So the index fund construct does a good job producing kind of periodic liquidity. Separately, there's a fund structuring thing, which is there any way to make this fund to have it provide liquidity if people want to get all the way out? And it's not as good for that, only because it's a little bit hard to support liquidity if there's not necessarily buyers for your shares. At the end of trying to get somebody out of a fund, if there's not somebody that wants to get into the fund to match them up with, you have to sell assets in the fund. And to the prior comment that we both just hit, there's not a real functioning secondary market for most potential assets in a VC fund.
What would you say of your universe of coverage? Is it like 10% that have some sort of liquidity event that is returning capital back from those shares?
Well, putting aside the last year and a half where it's been, the market's died and stayed dead for a while and are only starting to come back to life in terms of the production of liquidity events, corporate level liquidity events. When we were originally modeling the trade that we're doing right now, we expected about half of the portfolio to go to zero, which is two different types of zeros. There's corporate level zeros, and then there's where we're getting access to common stock. And sometimes a company can have a fire sale acquisition where some of their investors get money back, but the common stockholders get nothing. We were expecting about half zeros and the other half non-zeros, and there was a not quite uniform, but reasonably uniform, predictable batch of liquidity year over year over year, all the way up until you get to the handful of companies that are just holding their breath 10 to 12 years for an IPO. And so we expected about half to be liquid in our initial modeling, and we expected that half to be comprised of like 5 to 10 percentage points on a yearly basis going towards year 5.
Interesting. Okay. So with that said, if there's anyone out there looking to get access to something like this, besides reaching out to you directly, which I know you're a very busy guy and would probably prefer not to, what's the best pathway for them to get access to the investment vehicle that Vested offers?
So for any high net worths who have their money managed, so for investors who would like to be in VC and might want to take a look at our fund products, the best thing to do is go up to the financial advisor who's managing your money. And the best thing for the financial advisor to do is to go to the highest level within their organization. Hopefully there's a team that kind of sources and diligences potential fund investments on behalf of the overall platform at which the financial advisor works. And I have personally, and my team, we have sufficient bandwidth to work with at the platform level. And so the best way to get a hold of us and just, is to go to vested.co/investor from somebody at the platform level that has like one of those seats that's diligencing many managers and many funds.
Right. Okay. Okay, Dave. Well, I really appreciate you coming on today. It was a very interesting conversation. I know as a founder myself, it's something, I keep an eye on for my employees on just our pathway to liquidity. So I think what you're doing is a very positive thing to the industry, especially amongst a lot of the headwinds going on, especially amongst the trend of companies staying private for longer. So I really appreciate you coming on today, and we'll leave a link to the show notes for anyone interested in learning more about Vested as well.
Awesome. Thanks for having me on, Cam. Appreciate it.